Ever wonder how companies figure out if they're actually making money? Or how investors know whether a business is worth trusting? It all comes down to the financial statements. Hey there! Welcome to Module 3. In this video series, we're going to learn how to prepare 3 of the most important financial statements: the income statement, the statement of changes in equity, and the balance sheet. We won't be building a statement of cash flows just yet. That comes later. But I'll give you a quick overview of what it is and why it matters. Before we dive into the actual numbers and start solving the problem, we need to get clear on what each statement is, what it shows us, and why it's useful. So this first part is all about understanding the big picture. Let's start with the income statement. This statement tells the story of a company's performance over a period of time, how much money it made and how much it spent. It's all about revenues and expenses. And the key formula is revenues minus expenses equals net income. In other words, did the company make a profit or not? And if so, how much? This is usually the first place I look when evaluating a company. I want to know, did they make money this year? Was it more or less than last year? That's what the income statement answers. You might also hear this called the Statement of Operations or the P&L, short for profit and loss. Regardless of the name, it shows the same thing: how much the company earned, how much it spent, and whether earnings exceeded expenses. If they did, we've got a profit. If not, there's a loss. Next up is the Statement of Changes in Equity. This one shows how the company's equity accounts changed during the period. Across the top, we'll list each equity account. In most intro accounting courses, we focus on 2 main ones: common shares, CS, retained earnings, RE. Here's what the statement shows. What did we start with in each account? How did each amount change during the period? What's the ending balance? This statement tracks things like net income being added to retained earnings or dividends being subtracted. It gives us a clear picture of what happened to owners' equity over time. I'll admit, I don't find this one as exciting as the income statement or balance sheet, but it's still essential, and you need to know how to prepare it. Now let's talk about the balance sheet, another crucial one. This statement shows what the company owns, its assets, what it owes, its liabilities, and what's left over for the owners, equity. The core formula here is assets equals liabilities plus equity. This is why it's called a balance sheet. Both sides must always be equal. It's a snapshot of the company's financial position at a specific point in time. You'll see all the assets they control, like cash, inventory, or equipment. You'll also see the debts they owe and how much equity is in the business. When I'm analyzing a company, I usually look at the income statement first to see if they're profitable. And then I go to the balance sheet to see what kind of financial shape they're in. We won't be preparing the statement of cash flows in this section, but here's what you need to know. It's similar in structure to the statement of changes in equity, but it only tracks cash. It answers, how much cash did the company start with? How did cash move in and out during the period? What's the ending cash balance? Why does this matter? 2 big reasons. If a company runs out of cash, it's in serious trouble. That's why investors pay close attention to how cash is managed. Cash is hard to manipulate. Unlike other accounting numbers, cash is straightforward and trustworthy. You can argue about the value of a building or a vehicle, but cash in the bank is what it is. We'll cover this statement in more detail later in the course, but for now, just know that it's an important tool for understanding how a company manages its money. All right, that's your overview of the 4 main financial statements. In the next video, we'll start preparing them step by step, beginning with the income statement. Quick question for you before you go. Which of the financial statements do you think is the most useful? And why? Drop your thoughts in the comments below. I'd love to hear your take, and I always reply to the early comments. See you in the next video.